Welcome to lesson 4 on technical analysis. Our topic is what is a technical indicator? A technical indicator is a series of data points that are calculated by applying a formula to the price data and or volume data of a security. Indicators are derived by applying a formula, price data and or volume data of a security. For example, a simple moving simple moving average is a technical indicator that uses price of the security to find average price over a specific number of periods. Simple moving average that uses close price. Simple moving average uses close price of the security find average price over a specific number of periods. We will discuss all these technical indicators in detail, so don't worry about that if you don't understand over here. Similarly, on balance volume or OBV is another indicator that uses close price and volume data to calculate its data point. So this indicator OBV, on balance volume, this indicator close price and volume data. Volume is another indicator that uses only volume data to calculate its data points. And there is another indicator called AD, accumulation distribution indicator, that uses price data and volume data for its data points. In price data, this indicator, AD indicator, uses a high price, low price, and close price. So it is using three types of price data: high price, low price, close price, and volume for its data points. So don't worry if you don't understand these technical indicators right now. We will discuss all these indicators in my upcoming lessons. For analysis purposes, data points of technical indicators are usually shown in a graphical form above or below a securities price chart as shown below. I'm showing you a security. This is the price chart. This is the price chart. We are in candlestick mode, and in this picture you can see two indicators. One on the price chart, this indicator, this is called Bollinger Bands. This is called Bollinger Bands. So this is one indicator which is shown on the price chart. And here is another indicator. This indicator is called vortex indicator, and it is shown below the price chart of the security. Once shown in graphical form, an indicator can then be compared with the corresponding price chart of the security. Sometimes indicators are plotted on the price chart, or below the price chart. Why should we use technical indicators? Technical indicators serve three broad functions. Technical indicators serve three broad functions. Number first is to alert. An indicator can act as an to study price action a little more closely. To study price action a little more closely. For example, let us say that momentum of a security is decreasing. Momentum of a security is decreasing, then it may be a signal to watch for a break of support, or if there is a large positive divergence building, it may serve as an alert to watch for a resistance breakout. So, technical indicators act as an alert. Don't worry if you don't understand break of support or resistance breakout. We will discuss these support and resistance levels when we will come to our indicator support and resistance. So we will discuss these things in quite detail. The second function of indicator is to confirm other technical analysis tools. For example, if there is a breakout on the price chart, a moving average crossover could serve to confirm the breakout. Or if a stock breaks support, a corresponding low in the on-balance volume could serve to confirm the weakness. So indicators are used to confirm. And thirdly, indicators are used to predict. Some investors and technical traders use indicators to predict the direction of future prices. Now let's discuss some tips for using indicators. Number first tip for technical indicators is that don't focus merely on an indicator. No doubt, indicators indicate. This may sound straightforward, but sometimes traders ignore the price action, security, and focus merely on an indicator. No doubt, indicators filter price action with formulas. As such, they are derivatives and not direct reflection of the price action. This should be taken into consideration when applying your technical analysis. Any analysis of an indicator should be taken with the price action in mind. What is the indicator saying about the price action of the security? Is the price action getting stronger? Is the price action getting weaker? So you need to look at these things. Second tip for technical indicators is that signals should be taken in context with other technical analysis tools. Even though it may be obvious when and sell signals, the signals should be taken in context with other technical analysis tools. An indicator may flash a buy signal, but if the chart pattern shows descending triangles with a series of declining peaks, it may be a false signal. So this was the third tip for technical indicators. The third tip is that reading indicator is more of an art than a science. The same indicator may exhibit different patterns when applied to different stocks. Indicators that work well for one stock might not work the same for another stock. Careful study and analysis, expertise with various indicators will develop over time. The fourth tip for technical analysis is that kindly pay attention to indicators that are in use for a long time and have stood the test of time. There are literally hundreds of indicators in use today, with the new indicators being created every day. Technical analysis software programs come with dozens of indicators built in, and even allow user to create their own. So given the amount of hype that is associated with indicators, choosing an indicator to follow can be a daunting task. So please pay attention to those indicators that have been around the long time and have stood the test of time. I will tell you the indicators that are around the longest time and have stood the test of time. But for fifth tip for technical indicators is that choose indicators carefully and moderately. Attempts to cover more than 5 indicators at a time are usually useless, are usually futile. It is best to focus on 2 or 3 indicators and try to learn a lot about those 2 and 3 indicators. And the sixth tip for technical indicators is that try to choose indicators that complement each other instead of those that move in unison and generate the same signals. For example, it would be redundant to use 2 indicators that are good for showing overbought and oversold levels, such as stochastics and relative strength index. Both of these indicators measure momentum and both have overbought and oversold levels. So try to choose indicators that complement each other instead of those that generate the same signals. So this was all about this lesson. I hope you like this lesson. Thank you very much for watching this video. Happy trading to all of you.